Fintechs, where fintech meets politics. We bring together national and European policymakers with the entrepreneurs and visionaries of fintech.
Welcome everybody. My guests today in this episode number 8 are Ruta Merkevičiūtė, head of the Digital Finance Unit at the European Banking Authority in Paris, David Egner, counsel at Chartered Investment from Düsseldorf in Germany, and Darren Nesbitt, CEO at ABS from London. My name is Konstantin Fabricius and I'm the host of the show. In this episode, we talk about regulation in general. The topic matters because regulation has become more complex and wide-reaching, even for fintechs. At the same time, many segments in Europe are facing major consolidation. With this in mind, I sit down with 3 experienced experts to explore what regulation is meant to accomplish and how fintechs fit in the web of norms, standards, and recommendations. Should fintechs perhaps get some regulatory relief, especially with the big cost challenges they face? And what should we think about the ongoing presence of a large grey capital market in Europe? We covered these questions and more in our podcast. I hope you enjoy listening. Welcome Ruta, David, and Darren.
Welcome.
Hello.
Hi.
Yeah, great to have you in the show. And could you please quickly introduce yourselves? Who are you and what authority and business, respectively, are you speaking for today? Ruta, would you like to start?
Okay, great. Thank you, Konstantin, for having me here. So I'm representing European Banking Authority, where I'm heading a digital finance unit. And basically, our aim is to look and see what future brings, in a way, what innovations are happening in financial market. For example, AI, DLT, now it's quantum coming, and how it could impact the banking, payments. Is there opportunities for customers? And as a result of this job, we have already some of regulation on crypto markets, on digital operational resiliency, and so these are the topics I am working together with my team.
Thank you very much. Great to have you in the show today. David, would you like to go next?
My very pleasure, Konstantin. My name is David Egner. I'm an attorney, counsel, and structure at Chartered Investment Germany, which is a group headquartered in beautiful Düsseldorf in Germany. And what we are doing, we are focusing on enabling financial solutions for professional investors in very different way, whatever the solution might look like.
Perfect. Thank you. Darren.
Good morning, Konstantin, Ruta, and David. It's a pleasure to be part of this podcast series with you today. I'm Darren Nesbitt, the Chief Executive of ABS. We're headquartered in Canary Wharf in London. I've been at ABS for 16 years, running the business as Chief Executive for the last 5. And prior to that, I was involved in asset-backed trading at Barclays Capital. ABS provide a lot of different services within the asset-backed and securitization market, with one of the key services being regulatory compliance, obviously a key topic for today. For us, that's the UK, EU securitization regulation and central bank support schemes such as the Bank of England and the ECB. I think as securitization is the end game for a lot of your fintech members, especially if they're looking to raise large amounts of capital, circa 250 million euros plus, it's likely they'll be coming and working with us at some stage to help them on their journey from private financing through to the big scary public markets. So I think it's important that they're aware of the regulatory burdens that await them in the market when it comes to risk of all of its fines, sanctions. So yeah, that's me.
Great. Thank you. Yeah, guys, let's jump into our discussion and perhaps start with some kind of warm up. And Ruta, the first question goes to you. What does regulation of the European financial system mean?
Okay, so it's, of course, as a coin has 2 sides, it's not so easy to tell. So basically, I would structure in 3 ways. There are 1 regulation needed to enhance competition. And I think as your podcast listeners are those, I understand, that has non-bank lending areas. So this is an example of crowdfunding regulation in Europe that happened before as a result of maybe also initiative to have a competition, because in some countries, this kind of business model, crowdfunding, gathering the funds from the from the public authority and then public people and then lending was treated as banking. In some countries as treated as not regulated. So this kind of regulation brought a possibility for this kind of entities to be treated equally and to then provide services across Europe. Other regulation, of course, it is more related to protection of consumers, of financial stability. And for this, like in a way, of course, we have regulation for banks, for credit risks, for CRD, CRR. We have some regulation that was an outcome of digitalization, as mentioned, the Digital Operational Resilience Act. And we have also some kind of regulation like crypto, like MiCA, I would mention, crypto assets regulation that came as a result of ongoing monitoring on this phenomenon. Like, crypto came like 10 more years ago. And in the beginning, it was unlicensed activity, unregulated. A lot of has happened, like in a way, warnings to our customers. But when we saw that the customers are taking, I think in 10 years, we see that the crypto is a part of financial system. No, we see that banks are investing in crypto, that they are, for example, establishing subsidiaries, issuing stable coins. And so this is a part of the day-to-day financial system. Who would thought about that 10 years ago? So there is a different dimensions. I said two parts of the coin, but I think it's even 3 or 4 parts that has the focus of regulation in different angles.
Okay, great. Folks, can we simply break it down like this? Does regulation perhaps mean separating the good from the bad? Hence, all those who are not neatly regulated and centrally supervised are evil. David, Darren, what's your take on this?
I think it's not really about somehow a delineation of moral nature or of an ethical nature, what is good or what is bad whatsoever. I feel like regulation is more or less about the guardrails for a mutually consented road on which all good and bad players may take their route, so to say. And I do not want to miss out to mention that, because I found that when it comes to the question what Ruta already perused on with regard to what regulation means and whether it is somehow a route for separating the good from the bad, as you just mentioned, I found that lovely citation from a speech I just read prior to that podcast on the future of financial services by Myra McGuinness, the former vice president of the European Parliament. And she was quoting one thing which I found, like, from a more or less theoretical regulatory theory point of view, very, very enchanting to bring that up in this discussion today. And she was quoting, I love to quote that, she was saying, "I believe that the entire financial system lives or dies on the basis of trust. So it's key to financial stability, it's key to consumer belief in and trust for the financial system." So that said, I feel like financial regulation, and that was what I feel for like 15, 20 years, I feel like financial regulation is somehow a facilitator on trust on both ends, on the markets and the investors on the one hand, always depicting in the very first recitals of each and every single legislative act of the European Union, saying like providing market stability and providing a degree, a level playing field on investor protection. But it also provides trust on the other end, which is intermediaries and services. So it's kind of a servant of two masters. And that is what I meant with guardrails. So regulation would never end players being good, or better to say, being bad, right? But it's about like taking a route together, taking the educational part of implementing the services within the system of European financial services, and hence I would keep that moral discussion of bad players entering the market due to a new regulatory environment, like the crypto regulatory environment, for instance. It is not about extracting bad players from that particular market, but it's providing the guardrails, providing the conditio sine qua non for entering the market, somehow a regulatory entry barrier, and then supervising them in an appropriate way. But that is definitely, we want to discuss that point of regulatory arbitrage and supervisory arbitrage later on.
Great. Thank you, Darren.
Yeah, I think clearly my focus here is around sort of the asset-backed and securitization market in general. The regulators tend to treat securitization a bit like a fine wine. It has to be aged, specially labeled, well documented, approved by 27 committees before anyone can touch it. And clearly ABS securitization was given the label toxic and labeled as the cause of the global financial crisis, as a very star-studded film highlighted. But clearly it's not a bad product. It was used badly. So proper regulation is very key here in everything that we do. I think prudent regulation is key to ensuring stability, definitely. So there are a lot of cases out there of unregulated markets, unregulated entities that kind of give and raise cause for concern, especially for the regulators. I mean, there's certain products that have existed for so long as unregulated, and I think that's incredibly dangerous. So there are clearly different lending practices covering this market, and not every lender is the same. So there's a lot of changes coming. I think even specifically within securitization, we're seeing the biggest changes to our regulation for a number of years. The European Commission have set out a list of proposals on the 17th of June aimed at revitalizing the securitization market, which has been sort of earmarked by a lot of senior people out there in the European Union. So a lot of the focus of this regulation at the start was about investor protection, transparency, financial stability. There have been a number of challenges over the years around this, things like the definition of what is private, what is public. That's certainly at EuroABS given us an enormous headache. So clarification on points like this that the regulators need to focus on is very key. I mean, the good news, I suppose, there for a lot of entities is there's potential simplified due diligence requirements coming for investors, lighter touch reporting templates for originators, with some loan level reporting being removed altogether. So there are changes to the capital requirements regulation. I think in reality, all of these changes have to go through quite a few legislative processes, including, review by the Parliament, review by the Council. Everyone appears to be on the same page, but I think the pessimist in me can see delays, negotiations, potential amendments and disagreements. So in reality, none of this is likely to change until 2027, but it all seems like a step in the right direction of getting everyone where they need to be.
Okay, brilliant. Folks, where are we today, 18 years after the financial crisis and the big overhaul of the regulatory acquis initiated by the G20 Pittsburgh Summit in 2009? We have now talked about today, but what is about the past until today? What's your view regarding the past 18 years?
Should I start? Okay.
Yeah, please.
Okay, so I think, the crisis, opened the reality check, at least in Europe, to understand that, okay, we are looking at one thing, but we interpret it differently. So I'm looking from this supervisor's perspective. And it was, really a good target, and we are working at a single rule book to interpret things in the same way. And we still, have some kind of a discussion among competent authorities how interpret one way, though we are looking to the same thing. And in 10 years, of course, more than 10 years, if 18, yeah, it's 18, it really evolved, it really matured, and it's normal, like a cycle, to look at that and say, okay, if it's something already mature, is it something to be simplified? Like, if we understand already seeing one thing in the same way, do we need to describe it? And I guess now we are in this circle to revisiting what has been done. Is it still needed, or is it, by default, is like tradition to be followed, and then we could focus to more urgent things, or some kind of other area. So what one of the points that Darren mentioned about reporting, for going to this financial market. Yes, so for being listed company, it was a whole way of papers what to be done. Now there is two different things. Digitalization changes, the approach for customer changes. For them, reading a lot of things doesn't give a possibility to take decisions. Also, the way how they understand what's being said is different. And of course, I'm looking to the proper retail consumer, because I think from professional investors, it's not a big deal. They are doing due diligence, though there were some cases then they relied on other due diligence, and by then nobody did due diligence. So basically, it's also very important not to like in a way to sleep on some kind of structures. So I think we have a possibility with this different mindset of the customers, different ways how they make decisions, make a bit more smarter regulation. So it's not deregulation, it's simplification, or it's smart simplification. And at EBA also we are looking to that, what is being done now, even, little things, could be streamlined, little things that could help to understand better what we want to say.
Maybe if you allow, let me jump in on this and seriously, just as a remark, I love regulation. Chartered loves regulation, so we kind of find that an essential part of being into financial markets. That's for sure, right? But I think Thatcher would very, very politely put the question into an answer like, we are in the middle of a very dense regulatory network, consisting of almost all mechanisms that have ever been thought of in regulatory theory, right? So we have an extremely diverse landscape of regulatory mechanisms implemented since or over the last 18 years that evolved over that consolidated in a manifold of topics. Just to name a few. Where are we? What you read from the Financial Times headlines. We are in stronger bank capital and liquidity requirements. We are in very extensive resolution frameworks with all the mechanisms or the measures being installed for the too big to fail issue. We have been in extremely increased transparency and market discipline, right? From all the conduct of business regulation stipulated by the European Union. We are in I would call them in extreme improvements of regulatory and supervisory architecture in the entire union. Once I remember that Alexandre de Lamfalussy always told about we want this Euro supervisor, agglomerating more powers to at least European-wide agency or agents that conduct the supervisory business of the European financial market participants. And what I feel is macroprudential regulation became way more central than ever over the past 18 years. Stating all this as a market participant, it was indeed in some respect a regulatory tsunami. It was a regulatory tsunami due to the circumstance that it is always good to have more transparency, for instance, increased amount of transparency. These days, I sometimes wonder how that transparency is actually scrutinized on a European level. Just to name a keyword, the DORA ICT register, for instance, what a tremendous amount of data is flowing into the European agencies. That is one thing, and the implementation itself is posing. It's not a market entry barrier anymore, but it's posing increased costs on financial market participants and an increased supervisory on compliance monitoring of each of those entities. That is somehow the downside. That's the downside we have cyclically experienced over the past 18 years.
Yeah. Thank you. Darren, do you want to add?
Yeah, where are we 18 years later? It's a tricky one. I mean, in a certain way, it feels like we're still trying to figure it out. I mean, the markets globally, I think about the US specifically, they kind of crossed everything out and started again and became this buoyant market again, whereas we still seem to be trying to figure out how things work. And we're going through an overhaul right now. I feel like AI seems to be solving a lot of problems. Maybe it can figure this one out for us as well. It's a real challenge right now. And who knows where regulation ends up. There's so many of them. There's so many different things that need to fit together. I remain positive, but yeah, I wouldn't want to be sitting in a regulator's chair right now.
Okay. Thank you. Let's move on to fintechs more in detail now. Although they existed before the financial crisis, they only really started to spring up like, let's say, mushrooms afterwards. And I think the regulatory restrictions imposed on banks by the decisions made at Pittsburgh have actually made a lot possible in this area. I think we're able to agree on this. However, regulatory density has increased not only for banks, but also for fintechs over the past couple of years. And today there are many provisions for them too that did not exist in the past. And these cost money, a lot of money, which is then lacking elsewhere, a real dilemma. And you, David, has just elaborated on this. Digital business models, therefore, deemed to increasingly difficult to overcome barriers to enter the market with new ideas. And players who have been on the market for some time already are facing intense consolidation pressure now. And this is particularly striking this year in the areas of payment and lending. David, diversity in the financial market could be a desirable regulatory goal, couldn't it? In addition, fintechs have already contributed a lot to the modernization of financial services. Should fintechs therefore be given regulatory privileges, especially in view of their current funding weaknesses? I'm very excited about the upcoming discussion now.
Maybe, Konstantin, if you guys allow, I would at least from more or less whatever fintech means, though, say. So, but what sometimes we at Chartered, we feel like a fintech when we delve into like financial solutions, like digital assets or tokenization. And we elaborate we take a lot of our time into discussing with other market participants where they are, where they stand, what they're doing. And maybe if you allow, just to undermine what you just said, Konstantin, with regard to that particular dilemma, a huge amount of fintechs are. Let me quickly just put the focus from my end, so to say, from my daily work, from my interactions with other market participants on the most vibrant points brought forth with regard to the actual dilemma, taking into considerations that we have a huge regulatory density, plus the strongest desire ever since for innovation and for bringing new concepts into the market. And I see like 4 particular dilemmas before jumping into the privilege section, so to say, which I would love to discuss with you guys. So I have it is always about the compliance costs, right? So we have a massive fixed cost on the compliance unit and the actual risk framework to be implemented. That is one thing. Then what I've always heard from my colleagues, while underpinning the circumstance that I said, I love regulation. That's for fintech, meaning that every euro spent on audits, reporting, licenses, etc., is a euro less for innovation, scaling, or market expansion, right? So thirdly, the funding climate. I don't know how you guys elaborate on this one, but I have the impression that the actual venture capital injection into the fintech market is cooling down somehow since 2022. Also because of the regulatory burden that weighs even more in this discussion. That said, I feel also that there are positive externalities that leads now to the circumstance whether there are privileges granted. When I see that fintechs more or less can broaden the access to finance, can access to the reduction of costs that may foster and promote the increase in transparency and push in incumbents to modernize financial markets. So that as a premark, so to say, now it comes to the circumstance how to privilege a market player, which is basically, in essence, from a regulatory perspective, offering a financial service as would be allowed to offer for a fully licensed bank within the European Union. So that comparison makes always this, and I see, that is for me one of the hot topics to discuss.
Yeah, I think that it's a really good point. I think for me, if it's the same activity, the same risk, the same rules, if fintechs are doing the same lending, for example, as banks, just in an unregulated space, why is there privilege there?
So, Ruta, we're all looking now at you, giving us answers to that question.
So I want to go to the different layers. And one thing that I agree, and we in the beginnings said, regulation. David said that regulation brings trust. So basically, being licensed is being trust, and licensing comes with a cost. And I think it's very important in the beginning because I used to work as supervisor and with fintechs. If you want to be licensed, there comes this kind of wish comes with a cost. And for a fintech or innovatory entity, it's always a choice to choose: do I want to enter this, or could I be supplying innovation to some licensed entities? And then we are talking about RegTechs, regulated technology companies who has no license, and plenty of them that provides AML, KYC solutions. They provide platform for tokenization, and there is nothing about regulation, but maybe it's also the way of having your revenues there. And then, of course, your question about third-party dependencies. So then it steps in DORA, operational resilience, because then we see that more and more services are being outsourced. So basically, the players who are licensed has to understand the risk and manage that. So it comes every time. If the business model change, of course, there is some risk has to be addressed. If it's too elevated, regulations comes in. And indeed, what I wanted to say that after crisis, there was a possibility indeed that to establish other business models that could create a synthetic bank, as David said. Basically, in 2007, 2009, we have payment service directive that enabled to decouple payment services. Then later on, we have crowdfunding that enables also a bit to gather the money. Then we have MiFID, of course, investment firms. So, couple a bit, if you couple payments, investments, non-banking lending, then you have a bank. And then there is a big question that is ongoing, really, if this kind of structures or this regulation and business models is not really becoming something that we cannot understand the risks. So there is like two sides, and this is ongoing discussion. And one of the things that we are looking also at EBA together with ECB on this synthetic bags, basically, super apps that as a customer, it's very good for me to have a different services by the end. If the crisis comes or something happens with one chain of railways, who is accountable? And we had some kind of also in US some discrepancies we have with some players in Europe where so-called white labeling model that you are branding. For example, it could be a brand of some unlicensed entity, and but under the railways are other licensed entity, and this brand branding entity that is not regulated, it is being something happens and then shuts down. Consumers don't know where the funds it. So in a way, if it's this kind of situation created, in a way, said I could agree with Darren. There is a privilege, like you as a non-financial entities, you could act as a bank without having any license. You have partners. On the other side, indeed, if you want to be a regulated entity, you have to comply with different regulation and bear all the compliance cost on that. So there is a discussion ongoing, and I see that there is no the one answer. I guess case by case assessment, and I don't even bought the question on big techs and how they are being involved, or what kind of impact they have in the market.
In reality, yeah. So there is just a barrier to entry. Whether that is just the cost is one of the key ones, but should that be relaxed to enable other entities not fulfilling all of the criteria to be involved? Does it increase the risk? I guess there's lots of different answers to that question.
Yeah, thank you, Ruta, for mentioning crowdfunding. I will pick this up later on, but before, I would like to add another thought to the discussion, and these are regulatory sandboxes. This is highly controversial in the ecosystem. There is a number of opponents of this idea, many of whom have actually founded fintechs themselves, and we have this kind of discussion even in our association. To date, we do not have, or to put it in other words, we are not able to have a fixed position on this because it is highly controversial. And I would now like to pour this question into this discussion here. So what do you think about regulatory sandboxes? And is this perhaps a way that should be increasingly used, or are you one of the opponents saying, no, we don't need to have regulatory sandboxes, same risk, same regulation? That's the deal. What do you think?
I would love to circle back on the citation I brought into the game by Ms. McGuinness earlier, circling around trust and stuff like that. When my perspective as a consumer or as a retail investor is always feeling like trust hinges on the idea that the same activity, same risk, same rules, right? That relaxing rules risks to undermine the confidence we try to somehow implement via regulation on that hand. Another argument against somehow a lighter treatment would be a distortion of the actual level playing field, which is in the mouth of the European regulator since decades in between. So that privileges for smaller fintechs, whatever that means quantitatively, qualitatively, could somehow distort, on the one hand, competition if fintechs and banks offer similar services, but face different costs. I'm always circling around the cost kind of side. Taking all this into consideration, I somehow feel, and I would love to hear your opinion on that one, I somehow feel that a regulatory sandbox is somehow a product, a really quantitative, given the lighter regulatory requirements, the touch upon, I'm thinking on the small AFM regime already introduced in 2013. So we have a lighter touch of regulatory requirements for certain players in the market, etc., etc. I feel that this is a product, finally, of the proportionality principle. So proportionality was always discussed somehow as a very esoteric philosophical principle in the union, be it in the insurance sector or be it in securities, that nobody actually knew how to actually operatively implement proportionality on that innovative idea I want to set up as a financial servicer, right? And now we have that regulatory sandbox. Everybody is criticized, or a huge criticism around regulatory sandbox, etc., etc. But in some respect, it is from that the sword of the Damocles that was always saying regulation should be risk-based, etc., etc., etc. So huge words on this one. And now we implement from small steps, like I said, the few articles in the AFMD relating to small AFMs. That was somehow a regulatory sandbox. We did it much more with the DLT pilot regime, etc., providing a new economic zone. That is an idea which is decades old, and I found that is one of those very appreciative consequences of the proportionality principle that was always discussed in European regulation.
One question I have, and kind of part of my ignorance here, I'm just trying to understand this question in terms of an example that I would use. So here in the UK, you have Revolut, who were holding significant deposits with restricted banking license, basically giving them a mobilization phase to be able to build out their banking operations, hold deposits, but with restrictions. Is that kind of the similar thing that you're kind of talking about here, regulatory sandbox to allow fintechs to kind of work under a controlled environment and build out for a period of time?
Yes.
Maybe I can step in. For me, a regulatory sandbox, I don't have a synonym that it's lighter regime. Basically, we have at the European Union this European Forum of Innovative Facilitators among competent authorities who established regulatory sandbox or have innovation hubs. So what is regulatory sandbox is only a place for regulators to understand new innovative business models. So what does this mean? If you are not new, if you are payment service providers, it's clear you are payment service providers. There's nothing to test there. And it is really was very important tool for, and once again, I'm going back to crowdfunding. When nobody understand what is that and nobody fit into the existing regulation. Is it banking? Is it non-banking? And then there is no clarity in regulation. This model is banking. Then some countries they use regulatory sandbox in a way to test this model with a limited number of customers, but not saying that a lighter regime of regulation is being applicable. It's just saying that currently regulation is not covering it in a way that we could say, is it banking or not, because we need to understand the risks. And later on, it was an outcome of some sandboxes with competent authorities that they use this outcome to inform new regulation on this testing. Another example I'm aware in insurance. Of course, insurance is not our field, but insurance is one of the areas I think they are still becoming more fintech-ish. And there was a platform, I recall, P2P insurance. So basically the same how crowdfunding works. People gather the money and then they gives an insurance to some mobile phones. And it was not the entity, it was also based on a crowd. And at that time, also, a regulator could not say, is it insurance? Because the Insurance Act is a bit different, what is insurance, but they had a possibility to say, no, it's forbidden. So this regulatory sandbox enables supervisors to understand better innovation. In a way, it brings the clarity for them, for new models, not to be afraid and say if a new company comes with a very innovative business model, they would say, oh no, I don't understand, then it's forbidden. So it's a possibility then to bring a comfort for a supervisor and a company to assess this risk. So for me, I would never, it maybe in the beginning it was some kind of misconception that it's lighter regimes. It's not. And it's what you would mention about, some examples of other entities. There is more flexibilities, and I see also in the market, maybe I would not call it regulated sandbox, but that supervisors are getting into, possibility for a company to issue a license with some kind of conditions in order to scale up. So it's also, I think, from the business-wise, it's a good opportunity, to test if a business model is possible. Because, some years ago, when I was talking with some banking supervisors, they thought that the bank is that with 10 people, 20 people, having a great capital to eat all the losses for 3 years. And it changes the possibility to have this kind of conditional licensing. It enables, in a way to enter the fintech. But at the same time, I tell you, it's the cost on that for a fintech to be really a mindset of the senior management that, as soon as you get licensed, you are no longer a startup. You are already licensed entity. It comes with the cost of compliance, and compliance should be your priority because you are given a trust.
I really struggled to see the kind of negative. I mean, I think it can be treated as a regulatory research and development for both sides, allowing supervisors to test, certain rules, allow the fintechs to work with the regulators. And I mean, especially in the kind of different iterations of AI that are coming through, it seems like it would be beneficial for both sides. And then going forward, having that sort of credibility that this has been worked on for the investor and market confidence sounds like a good idea to me.
Let me jump in. I'm totally with you both. I'm totally undermine everything you just said. It is a wonderful institution for the regulator and the supervisor as well to get to know financial innovation. Absolutely. Let me jump in with some critical thoughts, though. You all remember, it's almost 20 years ago, you all remember the testing of some extremely large suppliers. I suppose you use it as well. They rented a huge part of infrastructure to test delivery to customers via drones, right? Back in the days, it was discussed as a new economic zone. Like for testing purposes, they eased on aviation rules, they eased on several regulatory instruments, but solidly regarding that economic zone. So, but the difference from a regulatory sandbox we discussed today and those economic zones in other branches of our markets, like the drone testing example, was the circumstance that the drone testing that happened in this particular zone with an exceptional circle of certain participants within, right? The regulatory sandbox allows you to already provide that financial innovation to external parties under the protection of the regulator. So there's a fintech, or whatever that says, entering into that regulatory sandbox, providing its insurtech or whatever financial solution they invented already to the customer, already to the consumer. That propelling a certain kind of risk to the ever since proclaimed goal of investor protection. That's one thing. The other thing is, how is the market then actually working? So young startups enter into the regulatory sandbox, and they provide those services to consumers, to investors, etc., etc. They develop over time. And how is the market, market reality actually working? So a big insurance or a big bank or a big asset manager is not entering to understandable reasons into that regulatory sandbox because they cannot, so to say. And then the consolidation happens on the M&A market a few years later when big banks, big insurance companies buy into those financial innovation. And is that really propelling market competition of whatever sense? When the actual takeover takes place years and years and years after. That is what I found quite critical about regulatory sandbox, because it's a testing and a free commercial due diligence for the bigger players in the market.
Okay, thank you. Let's move to the next important point, which is arbitrage. And looking around the EU member states, there seems to be a great deal of interest in supervisory arbitrage. I think a particularly shocking example is Germany in the area of crowdfunding. And at this point, I am picking up, Ruta, your remarks on crowdfunding. There in Germany, the national legislator allows for a huge unregulated area that is not monitored by a central supervisory authority to exist alongside the ECSPR, the European crowdfunding service provider regulation. And now there is a huge amount of uproar because investor losses are skyrocketing. But this is just one example. It's not the example, it's just one example. And my question to you guys is, to what extent can such developments still be tolerated without contradicting the goals of regulation and fair competition that we discussed at the very beginning of the show? Who would like to start?
I can, just start from regulator perspective. In a way, there is different theories when regulation is needed. Sometimes you leave the market to grow. And, from regulated point of view, when we assess, because we are looking also for, I cannot, just for clarification, I cannot comment a particular German model that I am not so aware, but in general, if we are talking about different, the same activities or similar activities are not being regulated, usually there are different concepts. Of course, you can regulate, but, in a way you have to be sure, we have to be open that regulation always is later than the business development. And the question is when regulation should strike in, especially if we have an level playing field. So there are different dimensions that basically the scale of the market. Is it a big phenomenon or not? So I'm just saying, from my perspective, are we talking about retail clients or not retail clients? And then what is the impact? Is it really, coming with a lot of losses that, like the industry itself is misbehaving, in a way being mistrustful or, some kind of fraud coming. And I take as a parallel crypto. Like I said, crypto regulation came into force in Europe. It's only last year. Crypto we had in Europe 10 years ago. And in a way, it had a shift, for being forbidden to the shift that everyone at the, at everyone in society is investing in crypto. And there is a scalability and you see investing, but also the players are not playing fairly, that need some kind of regulation. So I look from this kind of angle that, yeah, you can regulate. And it's very what I noticed then the fintechs becoming regulated, they are very eager to see how others are doing. It's very good policeman for the market. And I saw it in my previous experience with the consumer credit, then the consumer credit providers were into that. They into the regulation, they tried to look how market looks and they send all the letters for supervisors. Oh, there is unlicensed activity there. Please take care of that. So it was very good policeman. And I think it's also, in any case, if we see that the similar activities are more risk, it's something to assess also for supervisors. It's a good way to understand, is it really ready to be regulated, or is it just one phenomenon, one fraudster or something like that happened? So there is in a way, a couple of points to be on scales in order to say, do we need regulation at this point? And we already agree that Europe is already a lot of regulation going on. So I think we have to be precautious on this. Do we need the regulation once again in this particular area?
Do we generally believe that the only or one of the only reasons that people are doing the regulatory arbitrage is down to cost, or are there other factors within that?
Getting to that question Konstantin posed with regard to regulatory arbitrage, I mean, in a sense, to state that very, very clearly from my perspective, Europe may not at all tolerate any regulatory arbitrage anymore at all, right? That is fact. So, but as Ruta, as you indicated slightly, I think that the regulatory arbitrage in that sense we discussed 20 years ago is dead by now. Because there is a trend to the maximum harmonization of regulatory requirements, et cetera, What I rather feel is looking at the consistent approach within the European Union, I rather see a trend to supervisory arbitrage, so lower enforcement mechanisms within certain states. I do not mean central states where there's a lot of financial market activities going on, like Germany, France, Luxembourg, etc., but in the Baltics, etc., where this may give rise to concerns that supervisors are not really monitoring and tracking in a consistent, harmonized way the regulatory requirements. And still, however, I see also a huge temptation for arbitrage in whatever sense you would call it, like regulatory, supervisory arbitrage, whatever color you will put in there. And from a very practical perspective, I see two really, really decisive things for startups, at least in the fintech scene, which is on the one hand compliance by design, which is integrate compliance as early as however possible in the product development of that particular solution you're going to offer. That's one thing. And somehow also a regulatory mapping and the substance tests associated with the business setup. So checking whether the business is economically equivalent to banking or investment or insurance activities. And when considering passporting, ensure genuine operational substance in any licensing jurisdictions, which is on the one hand reducing political and supervisory backlashes at that particular moment. And then if that is assured quite initially in the process, then the temptation of arbitrage is quite so they can resist that particular temptation in a certain sense. And that is also provided by the regulatory sandboxes, which are unilaterally harmonized in the European Union.
Okay, thank you. Guys, we have almost reached the very end of today's show. And let me ask you some kind of crystal ball question after we have now touched on so many different points. And let me briefly ask you, what's your vision for the European financial markets? So what is it by looking into the crystal ball? What do you expect?
Okay, so I will start what I expect. The thing is that I am in a way trying to be positive. And one of the way why I'm positive because in European market, everyone cares. So everyone cares to develop, to improve, even though we are talking about banking, non-banking, fintechs, nectechs. So this is a very good positivity and a positive way that something evolving. The same evolution is also seen at European regulators, both supervisors, both European Commission. So what is only the need is, to get into the practice and this kind of proposals that it could be practical and really had a bigger impact on this competitiveness of Europe and all this stuff. So I am positive. We are going to the right direction. I think the reality stroke to Europe and everyone understand that there is a need of change. There is a proposals for a change, savings and investment union, other digitalization, artificial intelligence. Now it's the way to really come step by step to the implementation and actual practical pragmatism in this area.
Yeah, I mean, I think there's a lot of positive noise out there coming from everywhere, whether it's the European Commission, the Union, the EBA, ESMA. There's all of the focuses on getting things up and running properly in the EU, and clearly, as I've highlighted before, securitization and ABS is the sort of framework for where I'm focused, and that's going to be a key and important part of everything we're talking about as well. It is the kind of end game of growth and success. So there's so many regulations out there, from MiFID to DORA to the securitization regulations to MAR to everything, right? So getting all of those connected is a real challenge, and I think none of it should be rushed, because there's certain elements of these regulations that have to work in harmony, and if they don't, we start to have problems, as we've been experiencing since the GFC happened. So, but I think all of the noise generally from all of the senior regulators, politicians, is genuinely positive. Everyone understands that capital markets and securitization is fundamental to the economy. So yeah, I feel very, very positive about all of it. And I love regulation as well. I'll echo David.
Oh, that's a good thing. That's a good thing. So I quite attached to what you, Ruta, and Darren just said. It is just like lending that particular theory of what you already mentioned at the very beginning, Ruta, which is smart regulation. Why is that required? It's just not the buzzword, but it's a theoretical backbone of modern regulation, providing smart regulatory instruments to the market. So why is that? Because when you look at the emerging regulatory environment of digital assets, of cryptocurrencies, of decentralized finance in general, then you experience that there is a huge cross-sectoral regulatory approach happening at the moment, because it's not really getting into those cascades, banking, insurance, securities, but it's transcending between all those supervisory pillars in a certain sense. And that is be it that it comes from a practical experience, or be it that it is an objective of the regulator itself. But anyhow, that seriously requires smart implementation, getting all the guys on the table, discussing cross-sectoral consistency in a certain sense, that every single intermediary being in one of those pillars is treated in a way on a risk-based approach, with the same rules, with the same objectives, etc., etc.
Okay. Thank you very much.
What do you think, Konstantin?
Yes, that would be amazing now to know.
Yeah, I'm just the moderator, and you are the esteemed experts, and I have another stage where I'm able to call that out. But this show is really exclusively for you guys. And but nevertheless, thank you very much. That's the end of today's show. It was really a huge pleasure talking to you, Ruta, Darren, and David.
Thank you so much, Konstantin.
Yeah, thank you everyone for listening. You have hopefully also enjoyed this episode. Please make sure you subscribe to our podcast. Stay safe and sound, and see you soon.